Hey guys, really appreciate you joining me. It's Monday evening, whether you're watching this tonight or maybe tomorrow morning, really appreciate your time. So, thought I would do a briefing given the recent events and the market sell off. It's something we haven't really experienced significantly in the last, call it 18 months. And so, it may have caught some people by surprise and kind of seeing this amount of red is never fun. So, I thought I'd address it head on and maybe calm some nerves, give you some peace of mind, and some color around what's going on. And by the way, if you don't want to watch the whole video, I completely get it. Just know that we're not worried long term. We're going to be fine. Market fundamentals are still very strong. The economy is still relatively strong, given all the events of the last year and a half, 2 years. I mean, it's phenomenally resilient and strong, and so it's still the case today. And these pullbacks tend to be very short lived. So we're not worried. We're not panicked. Just know that. And so, if you'd like to just take that and use that as a little bit of peace of mind, by all means. But if not, I'm going to get into a little bit more detail here. There's a few things that are probably contributing to this, and there's always a myriad of things that cause a market pullback like this. It's never just one thing, I'm sure there's more than what I'm going to talk about now. But I think just, after a huge run up, as we've had without any real crazy pullbacks, it's normal and natural for there to be a pullback, some profit taking. And so that's one reason for sure. And then there's also been some concern that maybe the Fed has not moved fast enough to cut rates. Maybe they should have at the last meeting. And maybe that's true, only time will tell, but that's been a concern as well. There was a weak jobs report that came out on Friday that kind of kicked off a pretty large drawdown as well. And so we'll talk more about that. And then last but not least, a little bit more esoteric thing is this unwinding of the Japanese carry trade that, I'll keep it in layman's terms, but it has been a factor. And I know if you've never heard of a carry trade, it may sound kind of crazy, but the reality is it's a pretty common thing, and it's just been an unwinding of this Japanese yen carry trade. So we'll talk more about that. It's absolutely affected things. But so let's get into it. So what's happened? So, and I'll paraphrase Ernest Hemingway real quick. So shifts in the stock market often occur gradually and then suddenly. So clearly we're now in this suddenly phase of that. So over the past month, the markets have rotated from large cap stocks, the technology stocks, think Magnificent Seven, to small caps and other sectors. And so I've talked a lot about this, actually. The rotation is kind of what kicked off this market volatility and saw some sharp pullbacks and things like that. But following this latest jobs report that came out, which is a little bit weaker than expected, that's when really global stocks experience a sharp pullback altogether. It's really not about, stock market rotation at that point. It was just everything was down. And that due to concerns over the timing of Fed rate cuts, a weakening labor market, disappointing tech earnings, financial markets are obviously on edge as we're just adjusting to this new, kind of economic landscape. So important though, let's take a step back and just look at where we've come from and where we are now, just in terms of the market returns and really the resiliency of the market. And so I want to bring up this chart. This is showing the S&P 500 going back over 5 years. It's gained 113%, including the pandemic collapse and the 2022 bear market. So it's been very resilient, even in light of everything that we've experienced. So, while market pullbacks are never pleasant, never fun, viewing the market on these timescales, it does help to put the current decline, I think, in perspective. So, and you can see kind of various time frames in the chart. Obviously, it looks all the way back to 19, and then it looks at it from the peak of COVID-19. It's still up 60% since then. And actually, even since the latest all-time high is up almost 12%. So all these things have to be looked at in as a historical perspective. I think it's just a healthy thing. It's not any secret technology-related stocks, particularly those related to artificial intelligence, have contributed greatly to the market returns. The Magnificent Seven, including NVIDIA, the benefits from these recent AI trends. It's still up a whopping 162% since the beginning of 2023. And it's gained 362% since 2020. Just astonishing returns. So this rotation and now the pullback in these stocks is a result of, concerns, I think, over the magnitude of the rally and the large tech company earnings. We've talked about the concentration in the market in these AI related stocks, and it's been pretty apparent. So, and whether AI can live up to these lofty promises, it's yet to be seen. So it's not surprising that investors are growing a little antsy at seeing some returns on the billions invested by these large companies in AI. So market fundamentals still appear very strong regardless of these short-term pullbacks. Profit forecasts are still positive. The S&P 500 earnings expected to grow 13% over the next 12 months, and more than half of the S&P 500 sectors are expected to grow earnings by double digits. And all 11 sectors forecasted to experience positive growth. So, in the long run, earnings are what drive stock market returns. And so the health of the economy, it matters more than the short-term stock and, sector trading activity. So just important to keep that into historical perspective. But let's turn now and talk about the actual pullback that's occurred. NASDAQ's now in correction territory. That's defined as a 10% decline from recent highs. The S&P's dropped off 8% from recent highs. And the Dow's been a little steadier. It's had a drop off of 6% since recent highs. But here's the thing. Even with those drop-offs, S&P is up 9% year-to-date. NASDAQ's still up 8% year-to-date. And Dow up 3% year-to-date as it stands tonight. So still a very firmly positive market. Obviously, things could go down from here throughout the rest of the week or what have you. But this is just to show you that, things have not dropped off a cliff here. We're still firmly in positive territory. And, whether that remains the case is anybody's guess. But another thing that's really spiked here is the VIX. The VIX is the market's fear gauge, for lack of a better term. It's, it's volatility, right? And it's trading above 50. So this is significant because it's a level we have not seen since 2020. But I want to talk about this for a second because I think this is interesting. Statistically, a rise above 50 is very bullish for forward returns. And so since 1990, the VIX has only risen above 50 75 times. And so, but over the next 12 months, the S&P 500 traded higher 74 of those 75 times. And so it's like a 99% win rate. And so in the near term, we expect the market to be volatile, which I think would be natural, but it's not the time to make any rash moves. And so I brought out this chart here just kind of to illustrate that. So we see the VIX going back to 1990 here, and that 50 is that dotted line. It's not every day we hit 50 or above in the VIX, but we did hit VIX 50 on August 5th, which was today. And, this chart to the right shows that historical forward win rate with the VIX at or above 50 is 99%. So out of the 75 times, as I said, 74 out of the 75 times was positive. So no predictions, not saying that's going to happen this time, but I think you do have to look at this in terms of a historical perspective. And the reality is this type of volatility can be a bullish sign. So again, things can always change. It doesn't guarantee anything, but I thought that was interesting. So, look, stocks never move up in a straight line. So how we react to market volatility, whether you're a retail investor, professional manager, that's just way more important than the volatility itself. And so, yes, the S&P has now experienced its 5% or worse pullback, this year. And I'll bring up another chart here. And this just kind of shows that even still, this is well below the average of 4 to 5 pullbacks experienced in the average year, and dozens during bear markets. You can see that indicated here. All the 5% or more pullbacks experienced in any given year, it's pretty substantial. So we're very low by historical standards, even given the recent pullbacks. And this is this next chart is really one of my favorites. I use this a lot. You guys are probably sick of seeing it, but going back to 1980, we're looking at annual returns and then pullbacks. So what we're looking at here is the bars, the dark bars, are the return, the final return of that year. And down below, the sea of red dots, I think they're red, I'm colorblind, but they're dots anyway, of negative returns. These are intra-year declines in each of these years. And so even given the sometimes large intra-year declines, you still end up the majority of the time in positive territory in the stock market. It's the reason we invest. In fact, since 1980, the average drawdown, intra-year drawdown, is 14%. So it's not uncommon at all. In fact, we're well below average right now. So, for many of us, I think the volatility since 2020, the pandemic, it already kind of seems like maybe a distant memory, but because the steady recovery of the past year and a half, it's been so non-volatile. But I'm going to throw a little bit more historical perspective at you. From 1928 through 2023, the S&P was up 70 out of 96 years. So that's 73% of the time. And so in 35 of those years with positive returns, there was a double-digit correction along the way. So in other words, half of all those years where they gained experienced a double-digit loss along the way. So a 5% downturn is pretty much guaranteed most years. And a double-digit drawdown happens, roughly 2/3 of all years since 1928. And then if you look back to 1928, the average intra-year drawdown during that period, even an even longer period, was 16%. The average intra-year decline, 16%. So just to keep things into perspective. So I'll pull up one chart. I just found this kind of fun and interesting. U.S. stocks have been chill in 2024. If you look at 2020, you kind of see the large dispersion. 21 was tighter dispersion, and then 2022, when you had stocks and bonds down and things got a little dicey, a large dispersion. And 23 was a great year for stocks and kind of a tight band for volatility there. But look at 24, even tighter band. Very, very nominal volatility in 24. And the only little outlier dot here occurred in February of 24. That's before all this current kind of craziness. But before February of 24, the last time the index had fallen 2% was actually way back in early 2023. That was 512 days prior to that. So, the point being, it's just been kind of an abnormally calm time. So we have to keep that in mind. Let's turn the page down. We'll talk a little bit about the concerns with the Fed that maybe it's made a policy mistake. I don't necessarily think so. I think the Fed's now kept rates unchanged for over a year. It keeps talking about seeking greater confidence that inflation is returning to its 2% target. Didn't want to do things too soon. So its focus on inflation has now kind of resulted in a weakening labor market, which some do fear could spiral, toward more of a hard landing. But look, how fickle market expectations have been, right? The year began with us believing the Fed would maybe cut rates several times due to this, imminent recession. Expectations then shifted after a few, hotter than expected inflation reports, and investors believing the Fed maybe wouldn't cut rates at all. Today, we expect the Fed to cut rates in September, and that really hasn't changed, and possibly each subsequent meeting. So, these swings just kind of show how difficult it really is to get monetary policy right, if not impossible. So, even as backseat drivers, it's very, very difficult to do. So, we did have this weak jobs report last week, and so this kind of exacerbated things. So these dynamics have kind of shifted the Fed's focus now to the labor market a little bit. So the Fed did acknowledge that it is attentive to the risks of both sides of its mandate, which essentially are stable employment and keeping inflation in check. So the latest jobs report showed that the economy added 114,000 new jobs in July. This is lower, as I said, than the consensus estimate of 175,000. Not a big deal, in my opinion, but unemployment, which was expected to remain at 4.1%, did rise to 4.3%. So it's still relatively low compared to history, but it is the highest rate of unemployment we've seen since the pandemic. So regardless, look, both sides of the Fed's mandate, maximum employment, stable prices, now strongly point to a September rate cut. But now investors are kind of concerned that the Fed's waited too long to cut rates. But whether this is the case is yet to be seen. I think very few would argue the Fed's made the wrong moves per se, but just that they maybe haven't timed them that well. But many may wish the Fed's cut rates at its last meeting, but it's regardless, it's likely to do so soon. So soft landing, in my opinion, is still very possible. Hard landing, not a foregone conclusion. Only time will tell. But I think, additionally, market concerns driven by tech stocks, the Fed, labor market, all these things do have a silver lining. The economy is still very healthy. Corporate earnings are still growing. And if interest rates do fall, which they most likely will, many other parts of the market could really benefit from that, and I think will. So, okay, let's touch on this Japanese carry trade thing. This has actually introduced a lot of volatility and downside to the market. So a carry trade essentially involves borrowing from a country with with low interest rates and a weak currency, and reinvesting the money in assets of another country with higher returns and think like such as the Magnificent Seven in the U.S., Treasury bonds in the U.S. But when the borrowing country's currency moves rapidly, as has been the case with the yen, these investors can be forced to unwind the trade. So I think, it's usually you're going to find this in larger institutions, trading desks, hedge funds, things like that. But it does affect things. And so the carry trade depends on the borrowing currency remaining cheap, market volatility remaining low, and both of those factors have turned against investors in recent weeks, especially as the yen has now surged. And so this is forcing them to close out their positions. This has no bearing on fundamentals overall or a weak economy. It's just a function of the carry trade. It's that simple. So the overnight sell-off was especially aggressive in Japan. We think we had it bad. They dropped almost 13% in the stock market. It was kind of their 1987 event. So lost about 13% on Monday. And that was following last week's interest rate hike by the Bank of Japan. Somewhat, I think, unexpected, but they actually hiked rates. And so the bottom line is, global stock markets they're interconnected. I mean, in today's world, there's no getting around that. Market moves, they're not localized anymore. They're, an event halfway around the world can impact U.S. stock markets, and it clearly does. So, but that's really kind of wrapping things up and to kind of give you some perspective. And so really the bottom line is, this is normal, even in a healthy market, a bull market. These things are normal, these pullbacks, and healthy. Fundamentals are still solid. Nothing is dropped off a cliff materially. Could there be more volatility, drawdowns? Certainly. There's no reason to think we're out of the woods yet, but also no reason to panic, given the perspective of a long-term investor. So, and we know these things can't be timed. I mean, they happen very swiftly and can turn on a dime. So no time for rash moves or anything like that. So we just have to stick to the long-term game plan. But just know that we're monitoring things. We'll keep you abreast of any material changes, anything like that. As always, I'll continue to communicate via the blog and videos and things like that. But thought I would just address this head on, given the nature of the market sell-off and something that hasn't occurred in quite some time. So hope this brings a little color to it, some perspective, maybe calm some nerves, and really appreciate your time, folks. I will follow up. I'll actually probably include a written blog with this at some point, and maybe the slides. But in the meantime, please reach out with any questions or concerns. We'd be happy to talk with you. Other than that, have a great night and a great week. Thanks, guys.